Welcome to Creamer Media's Resources Watch, a weekly video roundup of the events and people making and shaping the news in the mining industry. This week, fuzzy social obligations render South Africa less competitive than Australia. Analysts warn that Harmony is taking the tiger by the tail in PNG. And Goldfield South African mines gush 1.3 billion rand in free cash. DRD Gold CEO Neil Pretorius believes high Australia-level mining taxes are more preferable to the fuzzy, indeterminable social obligations imposed on South African mining companies.
As government finds itself less and less capable of delivering into some of these social imperatives, which is what's keeping them re-elected, getting them re-elected, and they try to transfer more and more of those into the lap of the private sector, that we could become less competitive. A whole lot of the social obligations around housing and health and education and so forth are being transferred from the actual custodian of those obligations, government, into the mines as a condition to their licenses. And that's almost a hidden tax. And it's also a counterproductive tax as far as I'm concerned, because the more you've got to spend on that, the fewer people you would want to employ. So you're certainly not going to be creating more and more jobs if you're going to have to deliver into all of these obligations in order to keep your license.
South African analysts cautioned South Africa's Harmony Gold on going ahead with its nigh $5 billion Papua New Guinea project, for which it was failing to get credit in its share price.
I mean, one continues to look at one's strategy and understand the strategy of how you take the company forward. As Harmony, we have taken this asset certainly up the value curve. However, that's not reflected in our share price. What should the company be valued at? I think a heck of a lot more. If you do a valuation on the South African assets, you get a pretty good valuation. If you do a valuation on Wafi Golpu and Hidden Valley and the exploration tenure, you get a good valuation. And if you add those two together, you don't get equal to market cap, unfortunately.
Goldfield's much maligned South African operations generated free cash of 1.3 billion rand, some $161 million, in the June quarter.
We've lost around about 50,000 ounces out of KDC because of the fire. Cash flow has been good though, 1.3 billion rand of free cash flow from the much maligned South African assets in Goldfields.
For mining news as it breaks, stay logged on to miningweekly.com and register for our free daily newsletter.